Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleague Nigel and Rima will be with us in just a short while. Nigel, morning.
Well, morning, Prashant. Plenty of action overnight in terms of equity market, in terms of Trump's tariff talk as well. And from a domestic standpoint, last week I was just talking about maybe we get a holiday on election day and then we make that up on budget day. Appears that could possibly play out because yesterday the NSE went ahead, BSE they officially announced.
Yeah.
So you don't have any excuse now. You have to go there and vote, cast your vote, don't crib later.
And it's important. And I think it's happening after, I'm not sure, last month, I don't remember holiday declared.
For BMC election.
But I think BMC election, the last one was many years ago.
Yeah.
Okay, well, let's just take it from the top, right? Because news flow, it's not local at all. It's all global in that sense. At least, what is significant out there. So U.S. equities, not very much price action-wise. S&P about 0.16 higher. NASDAQ about 0.25% in the green. Banks and credit card companies fell, of course, after President Trump said that interest rates should be capped for 1 year at 10%. So Capital One, Amex, JP Morgan, Visa, across the board, if you can put those up, they were down sort of sharply. There you go, on your screen. Now, President Trump has warned of severe consequences if the Supreme Court strikes down his tariff plan. And remember, this was what was supposed to happen on Friday. It did not happen. And most likely this will be heard. No guarantees. The ruling will be there tomorrow. Tomorrow evening, essentially, is when this is now expected to take place. Now, of course, it's a long post, social media post, but it was basically saying that, over a 9-month period, the U.S. has collected hundreds of billions of dollars, and all of that will have to be refunded. It's going to be a mess, etc., etc., etc. So maybe a little bit of public pressure or pressure publicly on what the court essentially is thinking of doing. But as I said, this decision is tomorrow evening. Now, the only thing is day after is a holiday. So 15th is a holiday because of the BMC elections here. So in that sense, tomorrow becomes critical, important. It's almost like that Friday when we would have had the decision later in the evening and been able to only react to it on Monday morning. So it's something similar. So Wednesday is the decision in the court. Thursday is a holiday, and we come back and react to it, and of course on Friday. Okay, now U.S. this morning, President Trump, of course, is saying that he's going to impose 25% tariff on countries doing business with Iran. He's been sort of, ramping up the pressure, explicit open threats that if the Iranian regime suppresses protests, and there are protests across cities in Iran, if the regime suppresses protests violently, it's going to basically force his hand. And this, of course, I think is from the economic side, 25% tariff on countries or any country doing business with Iran. Now, India's trade numbers with Iran are pretty small, between $2 and $3 billion or so. And I think from a market-sensitive point of view, it's basically basmati rice exports, so names like KRBL, LT Foods, etc. Not very much. Some essential good exports, some import of chemicals, that kind of stuff. So it's actually pretty small. What happens to India's foothold in the Chabar port in Iran, which essentially bypasses Pakistan and gives us a sort of, a direct route to Iran, all the way into Russia, Europe, etc. I think those are questions. Remember, this is an important, critical, strategic venture for India, and this got a sanctions waiver from the US back last year. So we don't have clarity on whether this will sort of come under the ambit of these tariffs. I just go back to yesterday's session. Comments from Sergio Gore, the US ambassador to India, sparked the rebound, and I was talking about this for the last couple of days. How this is an additional factor, not a sufficient condition, but an additional factor, which I think markets will start to pay attention to, because you've got someone from President Trump's inner circle now stationed in Delhi. So in that sense, much easier to communicate with the president himself through him. Gore, of course, invited India to join Pax Silica as a full member next month. There was lots of hand-wringing and disappointment when India was not invited when this was formed late last year. This is basically to secure supply chains for semiconductors, AI, critical minerals, etc. So, Gore saying that his first initiative actually in India, essentially saying that India is going to be invited next month. This is good news. And of course, also saying that high-level negotiations are set to resume today. We understand from sources, though, that there are no formal talks scheduled. So this could be on the informal side. We'll track as this goes. Lots of numbers came through. The large cap IT kicking off earnings. HCL Tech numbers are a beat. TCS is largely in line. You'll hear from both managements as we go along. And yesterday, we were at the cusp. The Nifty was at the cusp of breaking a very long-term moving average, which is the 20 weekly moving average. We managed, with the rebound held by those comments from Gore, we closed above it, above the 20 weekly moving average, which now stands at 25,648. And that remains, in a way, an important level. Bank Nifty, also, it broke, or was at the cusp of breaking the 20-day, the prior session. It closed at the 20-day, as of yesterday's close, 59,415. And look at the close, 59,450 is where we left off as far as the Nifty Bank goes. So that's the picture and the overall setup. Nigel has walked across with what's happening on the F&O side of things and the positioning. Nigel, take it away.
Well, the bulls were looking for some kind of positive data point, and Sergio Gore really provided that in yesterday's trading session. The bounce, though, came from oversold levels, but could possibly be just a near-term relief. Though the bulls, they'll be counting on this 25,500 level holding out. The problem is the FI selling continues. Yesterday as well, they sold nearly around, 3,600 crores or thereabouts. And that sell number needs to cool off a little bit. What did they do in the index futures? Well, they went ahead and they added some short positions. So in yesterday's trade, they added close to around 8,700 short contracts. No signs of short covering as of yet. Well, that could be a blessing in disguise because the short positioning continues at around 92%. And as we have mentioned in the past, well, the short positioning at its highest levels all the way since October. So the FIs, they're building on shorts, but the clients, they're piling on the longs. So both of them working on the opposite ends of the spectrum. And actually, this sort of combination in the past has signaled that we do see a bit of a bounce from these levels. So let's see whether or not it does play about. As I said, they didn't cover shorts on index futures, but they covered the calls that were written earlier. And they wrote some puts as well in trade yesterday. To give you a couple of data points, the 25,700 call, well, close to around 20 lakh shares were shed yesterday. So those calls that were written earlier, they quickly packed their bags and got out of the market. While the 25,550 put, well, that saw a good amount of open interest build up. Keep in mind that this strike will expire today because today is the weekly expiry, being a Tuesday. So the bulls will want this 25,550, 25,500 level to hold out. And the PCR has corrected itself. We had pointed out yesterday two factors that could lead to a bit of a short covering bounce. One was the FIs being net short. The other factor was the PCR was at the lower end of the range at around 0.62. Now that's corrected itself because of the kind of action we've seen in the options data. And now it's at around 0.9. The levels to track on the Nifty, yesterday's low becomes important, 25,500, 25,473 to be precise in terms of a near-term support level, while resistance comes in at around 26,000 mark. You look at the options data, you have the 20, the 50 DMA, all of them come in the vicinity of around this 26,000 odd mark. The sector to track today is going to be the Nifty IT index because you have HCL Tech numbers were actually quite good, and you have TCS, well, yesterday towards the end of trade did perk up, but those numbers weren't too bad. So tech will continue to remain in focus. So let's see whether or not this can hold one end up. But the Nifty Bank, that was the first one that got off the blocks yesterday in terms of a recovery. And that managed to conquer the 20 DMA on a closing basis. So that one will have to continue to hold its own. Three factors to track from here on. That'll be the India-US trade talks. That's going to be important. Earnings as well, that continues to flow in. And there'll be some optimism getting into budget 2026. Net-net, we're in a bit of a range. The bulls will fancy their chances that they can defend this 25,500 odd mark. Prashant.
Well, thanks for that, Nigel. Well, Prashant Puroda is with us, Portfolio Manager, Emerging Markets at Allspring Global Investments. Prashant, good to have you with us here. Good morning. Thanks very much. This every day there is something new, and it's this 25% thing with Iran now. What's the sense? I mean, first thoughts on what you think about Iran and the implication for markets per se.
The implications for markets, especially after Venezuela, is whether there'll be a regime change in Iran. And if there is a regime change in Iran, the second question happens to, what happens kind of to the oil that is sanctioned right now in many parts, and will that also come in play as well? So it's kind of a wait and see mode, but if you look at the overall global geopolitical sphere, it looks like there's a game of poker going on. Last year, China showed their cards with rare earths, and now US is solidifying their oil card across the globe. So that's being played at the background, and we'll see if anything changes in Iran in the near term.
All right. Hi, Prashant. Morning and good to see you, Win. What do you make of all the sound bites we got yesterday? President Trump now is going after Iran. That may not be too good news for India because we have some kind of export that goes to Iran, and then, it puts us into a bit of a fix with regard to trade in the United States. But Sergio God yesterday, the commentary that came in there, at least the bullish participants here, well, took note of it. And that's why we saw a bit of a recovery just in intraday. Give and take everything. What do you feel with regard to an India-US trade deal? Do you think we're closer to it, going by all the sound bites that we've got?
I think the trade deal will only happen once Prime Minister Modi and President Trump maybe meet face to face. And all this, I guess, play back and forth will continue to happen. But my sense is they need to have a meeting and a face-to-face meeting to kind of solidify all their concerns across the board.
All right, Prashant, the last couple of interactions we have had, you said maybe 2026 could be a good year for Indian markets, and you've been quite bullish on prospects out here. How big a factor is this India-US trade deal? If it gets pushed down, say, 3-6 months down the line, would you continue to remain as positive? That going by the numbers, it's not a very big factor. The problem is sentiment. Sentiment could turn once we get a trade deal with the United States.
Yes, I think the sentiment can turn pretty quickly. And if you haven't built those positions still when the trade deal is announced, it will be tough to get back in. So it's important to be patient for investors. And you cannot really time this to perfection. But my sense is things are moving along in the background, and sooner or later, Prime Minister Modi and President Trump will meet, and things will move on from there.
Sooner or later? Is it sooner or later?
I mean, hopefully sooner for the markets, but we don't know what concerns each party has.
Yeah, absolutely. Anything you've done new in your fund as far as India goes, Prashant?
Monitoring kind of the earnings that will come through. There hasn't been a big position change since December. We're still slightly overweight in India, and we'll look through for the commentary that will come through with the banks and other sectors kind of reporting at the end of this month.
Got it. Prashant, we'll leave it there. Thank you very much for joining us. Good speaking with you. Quick chat and always useful. Let me just quickly run you through what's coming up here on the program. 8:35, we'll get you a discussion with the TCS top management team. 9:20, Manish Gurmani of Bandhan AMC is a market master today. 9:35, we bring you a special discussion on the new labor law codes notified by ICAI. Remember, TCS, of course, made a big one-time provision, and I think other companies will follow. HCL Tech speaks to us at 9:45 on their third quarter earnings. Numbers were a beat towards the end of the program. Latha in conversation with Macquarie Suresh Ganpati on what to expect from banks, NBFCs and insurance companies as they start to post results.
Welcome back. Hope you're having a good morning. Well, as promised, our research team is standing by with CNBC-TV18's top stocks that you need to track today. And right on top of that, it's going to be a couple of IT earnings that came in. Rima joins us to tell us about TCS and HCL Tech. Rima?
So let's start with TCS, where the numbers are largely in line with expectations. There's nothing spectacular, no big beat, but operationally, numbers have met expectations. In fact, on the top line, the company has beaten expectations with a constant currency revenue growth of about 0.8%, ahead of expectations of about a 0.5% growth. The company's margins came in at 25.2%, unchanged on a sequential basis, in line with expectations. The bottom line, though, was a miss. Profits declined by 12%, but that was on account of an exceptional loss of about 3,400 crore rupees. Majority of that came in on account of the new labor code, which hit the bottom line by 2,100 crore. There was a provision for a legal claim, 1,000 crore, and on account of restructuring. But the question is, the labor code impact was retrospective, done for the past period leave encashment gratuity. Going forward, the company says the impact is going to be very limited, just about 10 to 15 basis points. Now, on AI, they said the AI revenues are now approximately 6% of their revenues, $1.8 billion, growing very fast. But, as I said, right, nothing spectacular in the numbers. Nomura says the revenue in Q4 is contingent on that BSNL order coming through. As of now, there is no word on that. They expect FY26 revenues to decline by 0.7% and go up by 2.3% in FY27. Now, when it comes to HCL Tech, it's actually a pretty good beat. Ahead of expectations, the company's raised the guidance, top line growth 4.2%, adjusted margins at 18.6%. We're talking adjusted because here the impact of the labor code has been taken at the margin level. The company says on account of the new labor code, there was a one-time impact of 956 crore at the EBIT line and 719 crore at the bottom line. FY26 guidance has also been raised. Overall guidance now stands at 4 to 4.5%, but the services guidance has actually seen an upgrade even at the upper end. The guidance lift was on the back of a strong execution in Q3 and the deal wins that they have enjoyed in the past. And this quarter was about $3 billion. AI revenues for the company now account for 3.8% of the overall revenues.
Well, that's the lineup from TCS. You will see Krithivasan, the CEO, Aarthi Subramanian, this Chief Operating Officer, Samir Seksaria, the CFO, and Sudeep Kunimal is the CHRO, and you'll hear from them in just a bit. We also have the top management of HCL Tech, C. Vijay Kumar, the CEO and MD, and Shiv Walia, the CFO of HCL Tech, coming and talking about their numbers and, of course, the beat that they delivered in the quarter. Biocon is something we want to focus on next. Vivek is here with details. Vivek, morning.
Well, good morning. After the merger of Biocon Biologics with itself, Biocon had indicated that they would go ahead and launch a QIP. They had taken an approval, in principle approval, of raising up to 4,500 crore rupees, and this was mainly to go ahead and buy out the partners as far as BBL was concerned. In line with the expectations, last evening, Biocon went ahead and launched a QIP. The total size of this particular issue is close to 4,150 crore rupees, indicating close to 7.5% of equity dilution of the pre-issue equity capital. Now, the indicative offer price is at a marginal discount to yesterday's closing. The indicative issue price is in the range of 368.3 per share to 371.8 rupees a share. What will the company use the proceeds for? Number one, payment of cash consideration to Mylan, which held a significant stake in Biocon Biologics. Along with that, repayment of debt availed for the acquisition of OCDs or CCDs of Biocon Biologics, and a minor portion will be used for general corporate purposes on back of the large equity dilution going with the red with Biocon today.
All right. Thanks a lot for that, Vivek. Well, let's hop across to Upasana. She's tracking a whole host of stocks, Anand Rathi and GTPL Hathway. Morning, Upasana.
Good morning, Nigel. First up, let me start with Anand Rathi. Well, it's a steady set of numbers with improved net inflows sequentially. Now, if you look at the numbers on Y-on-Y basis, there is a good growth, but sequentially, the revenue has seen a decline of nearly about 3% at 290 crore. EBITDA is down 4% sequentially at 131 crore, and profit is steady at 100 crore due to the sharp uptick in the other income that is nearly about 64%. Now, looking at the AUM growth of the company, it stands at 30% on a Y-on-Y basis at nearly about 99,000 crores, and the company has almost achieved its FY26 AUM guidance with a target of 1 lakh crore. Now, management has also indicated that it is confident of achieving its growth guidance of nearly 20 to 25 5% every year. Now, moving across to GTPL Hathway, the revenue has seen an uptick of 5% on year-on-year basis. Margins stood at 12.2% versus 11.9%, and the net profit has also seen a single-digit uptick of 8% on year-on-year basis. Now, coming to revenues again, the digital cable TV revenue has seen a downtick of nearly about 2%, while broadband business has seen an uptick of nearly about 4% on year-on-year basis, which is why we can see the overall revenue uptick of nearly about 5%. So overall, steady set of numbers here as well. So all in all, we are watching out for these two stocks in today's trading session.
Brilliant. Thanks a lot for that, Upasana. Well, rice companies, they're going to be in focus post President Trump's comments overnight. Ria joins us to break that piece down for us. Ria.
Well, good morning, Nigel. Today, rice companies, including LT Foods and KRBL, are expected to be in focus after US President Donald Trump has imposed a 25% tariff on countries doing business with Iran. Now, in terms of the impact of Indian trade with the US, if you look at the rice trade for India, the US is a small but valuable market for Indian rice exporters. In FY24, India exported roughly 2.3 lakh tons of rice to the US, which is less than 5% of its global basmati exports. But if you look at India's rice trade with Iran, that is quite significant. Iran is one of the top destinations for Indian basmati rice export. And in FY25, India exported roughly 8.5 lakh tons of basmati rice to Iran, which is the major buyer for India after Saudi Arabia and Iraq. Now, India's share of basmati exports is roughly 12 to 20% of the total basmati rice shipments. So going forward, there could be some pressure on these rice companies.
Got it. All right. Thanks a lot for that. Ria, we'll try to get you further analysis and maybe invite a company shortly to break that down for us in terms of the rice exports. Let's wind this down with Sonal, who's here to tell us about some stocks in the news. Sonal?
Good morning, Nigel. More quarterly updates coming by Adani Energy Solutions, where the total order book came in at 77,787 crore rupees. Their total units sold in the Mumbai circle was around 2,487 million units, which was lower on a YOY basis. But Mundra units grew around 57%. And the company also says they are likely to surpass the guidance of 1 crore cumulative smart meters by end of FY26, going with green here. For Kalpataru, which is a Mumbai-based realty player, the pre-sales were down 14%. However, collections grew 17% on a YOY basis this time around. Another NCR-based real estate company, TARC, where Q3 sales came in at 412 crore rupees. Their 9-month sales came in at 977 crore rupees. Cash flows have continued to be strong both on a quarterly and a 9-month basis. So these stocks will be on our radar today.
Okay, all right. Thanks a lot, Sonal, for that. Well, let's do a quick recap of all the top stocks we just covered for you. The ones with positive news flow: HCL Tech, Anand Rathi Wealth, GDPL Hathway, Adani Energy and TARC. All of them will be reacting to positive news flow, while stocks with negative news flow include the likes of Biocon, LT Foods, KRBL, Kalpataru, while we are likely to see a mixed opening for TCS. That's about equities. Let's invite Manisha. She's here to tell us about the roundup of what's going on in the commodities market. Morning, Manisha. No stopping gold or silver?
Oh, well, absolutely. If you look at all of these commodities, well, we have seen most of them trade near their all-time highs. So silver is holding at around 83.5, gold just $20 away from all-time highs. And we have seen a near record high for copper as well in the overnight markets. With all the geopolitical uncertainty, expectation after the U.S. non-farm payroll data that we will see further rate cuts has been supportive for all of these tangible commodities. But what also has gained in the overnight market has been the crude oil prices. If you look at Brent, that is trading at a 1-month high, WTI at a 7-week highs, with U.S. levying 25% tariffs on U.S. trading partners with immediate effect. Remember, Iran is an important country for various commodities, including crude oil as well. Iran is the 4th largest within OPEC when it comes to crude exports, and we are looking at 3% of global crude exports from Iran as of now. So that perhaps is what is leading to markets. The scare about supply disruption is adding to premium in case of crude oil prices as well today. So everything in commodities trading in the positive in Asia.
All right. I mean, just amazing the strength we've seen in commodities. Manisha, thank you very much for that. Appreciate it. We take a break. We are back. We get you a discussion with the management of TCS post the company's third quarter earnings coming up in just a bit.
Welcome back. You're tuned in to Bazaar Morning Call. Well, let's get straight to a sector that's going to be in focus, the rice sector. This after US President Donald Trump has said that any country that does business with Iran will be subject to a tariff of 25% on any business conducted with the United States. Mr. Akshay Gupta, the business head bulk exports at KRBL, joins us on the show. Hi, Akshay. Good morning. Thanks a lot for joining in and answering our call. Well, the street will be waiting some clarity on this front. So tell us, Middle East constitutes a large proportion of your export business. Can you quantify your exports to Iran currently? And I believe it's been coming down over the years. So at its peak, what was it?
So at one point when we were taking LCs from Iran and the trade was completely open, we used to do about 250,000 tons of business only to Iran market, which translated to about $100 million at that point in time, which was about 2018 is what I'm talking about. But business since then, sanctions have, been imposed and business has been constrained more and more over the years. So today, our total exposure from KRBL's point of view is about $8 to $10 million, which we manage on a day-to-day basis because of the restricted markets. But industry-wise, Iran is a major market for the basmati rice industry. Okay. Total exports annually would be about close to 1 million tons a year. And so that's as a industry point of view, it's a big market.
All right. Akshay, just to reiterate those numbers, as of now, the business that you're doing with Iran is just $8 to $10 million. Is that correct? That would be ballpark close to around...
exposure.
Current exposure. And at its peak, it was 10 times that. Got that. Just a quick question. Some of these exports, I think the payments come with a lag of close to around 60 days or maybe 90 days. Would there be a risk to some of those payments? Because now they have already delivered the products, but payments are due. Do you see any kind of risk or is it secured?
No. So Iran business is mostly be routed through UAE. There are companies, Iranian importers have companies in UAE from which they do the transactions. But although that is there, we were doing business via the route of UAE, but the internal protests in Iran and the condition has, troubled the entire payment system. So yes, it is a point of worry for the entire industry. And the sanctions from the US, the 25% tariff from the US is just another, layer on top of the uncertainty. But what was happening in Iran itself was a point of concern for the industry.
Yeah, absolutely. Akshay, we'll invite you for a longer discussion, but this is very useful. Let me get an industry view as well. Dave Garg is Vice President in Indian Rice Exporters Federation. Dave, good to have you with us here. Good morning. What's the industry exports of basmati rice to Iran?
Iran is one of the most important markets for Indian exports. Currently, for the last many years, Iran has been the second largest market for Indian rice. And Iran is importing more than 99% of all exports to Iran are of basmati rice. If we talk in terms of numbers, from April till November this year, we have exported goods worth $470 million USD to Iran. That is around 6 lakh metric tons. And if we look at the figures for last year, it was 8,55,000 metric tons, and the total export volume was $880 million USD. So Iran is one of the largest markets for Indian exports. And since this news has come in, we have seen a drastic fall in basmati rice prices in the domestic market. If we talk in terms of numbers, last week, 1121 Sela, which is the parboiled rice or basmati rice, which is mainly exported to Iran, the price was around 80 rupees per kg. Since this news has come in and there has been a panic or stress in the market, the prices have fallen by 5 rupees per kg, and today that commodity is trading at 75 rupees. If we talk in terms of the payments that are stuck in Iran, so it has been reported that more than 2,000 crores worth of payments are there in Iran which have not been emitted back. Because if we see that this protest or this disturbance is mainly based in the central bazaars of Iran, so from where most of the commerce is done. So because of this, many importers have reported their inability to remit back the payment, citing fall in the currency.
Yeah. Yeah, so it's a very important export destination for Indian basmati rice. $470 million is the number you gave us, which is between April and November. They will have you back a little later, and have more questions. But for now, thank you very much for joining us. TCS is what we want to focus on. So third quarter numbers largely in line with expectations. Rima and I caught up with TCS's MD and CEO, K. Krithivasan, and ED President and Chief Operating Officer, Aarthi Subramanian, began by asking them about the quarter gone by and the recent very large acquisition of Coastal Cloud, $700 billion, one of the largest ever by TCS. Take a listen.
Our ambition is to be the world's largest AI-led services company. And we laid out 5 pillars through which we are going to achieve. And one of the pillars about that is how do we play in the larger ecosystem. And we said we are going to be more acquisitive going forward. Yes. And we believe this is the best way to achieve scale at speed. Okay, you can always build competency inside, but building competency at scale and speed, acquisition becomes very helpful. And this particular acquisition, Coastal, is very highly regarded, both in the advisory space and in the professional services area. And with the List Engage, what we acquired in the previous quarter, and Coastal, it keeps us near the top 5 of Salesforce consulting. Mm-hmm. So there are so many things going for us, and it also comes at this a highly profitable company. So we believe that the price we have paid is quite reasonable, and our shareholders will be rewarded in the long run.
In that space, is everything a little pricey right now, given the state of things with AI, etc.? I mean, I think it's cheap. I'm assuming, right?
This is as I said, like TCS is very cautious. Yes. With acquisition.
Yes, that's why I'm asking. 5 times sales.
So
previous acquisitions have been between.
We looked at what they are doing, their clients, kind of services they do, and their financials.
Okay.
All of them put together, it made a lot of sense for us.
More deals on in the works, Aarthi, if you want to come in. I mean, you guys hinted that you will be acquisitive, so it's not going to stop at, I'm assuming, 1 or 2.
So we are evaluating opportunities, and like we said earlier, I think there is a very comprehensive framework that we are looking at, and we've talked about the new age services that we are focused on. There's AI data, cyber, enterprise solutions, which Salesforce is part of, and digital engineering. So across those 5 or 6 services which are new age and important for the future of the company, we are looking at each of those areas, and looking at opportunities and see how best they fit into the strategy and what we want to achieve.
As we've started 2026, there's so much geopolitical noise and uncertainty. Now, this is the time when companies typically set their tech budgets for the full year. Are we seeing any cautionary pauses? How is discretionary spending and the environment today versus, say, 3 months, 6 months ago?
Rima, same question we answered last year also. The way tech budgets are finalized for the year has gone through a dramatic shift. Most of our customers are taking a quarterly call based on the opportunities that are in front of them, and it's more the ROI-based approach. And gone are the days where the budget for the whole year is fixed. So, but our second point is this macroeconomic uncertainty. I think people are also getting used to it. They are now coming to realize that this is going to continue, and they need to play within this, and they cannot be pausing the budget permanently. So the approach is, as I said, more ROI-based approach. Look at a program or a project. When is it going to yield the result? Is the ROI quick, or is it going to take 5 years?
So there's no change in the last 3-6 months?
No.
Will FY26 international revenue be better than FY25, as you had guided earlier?
We are trying. We are trying all our. We definitely have a high ask rate on Q4 to achieve that.
What's the ask rate, if I may ask?
It will be upwards of about 3 to 3.5%, I think. Okay, so it's a high ask rate. We are doing our best to see how. See, as I said, There is a improvement in Q2. That same improvement in demand environment continued in Q3, but Q3 happened to be a furlough quarter. So we are doing everything possible to ensure that we stay above FY25, but we'll make all the attempts.
Okay. Are the AI-led revenues, I mean, the street was very excited when in the analyst meet you quantified the AI revenues for the first time. At that time, it was $1.5 billion in annualized revenues. Now it stands at $1.8 billion. Can this run rate sustain this 15-20% quarter-on-quarter growth? And where can it lead to? Today, AI-led revenues is still single digits, a little more than mid-single digits to your overall. I mean, give us some sort of an immediate goal, say 1 year down the line. What could that number look like? And what does it tell you about the rest of the business? Because that seems to be degrowing then, if this is the primary driver.
So when you look at the spend on AI across industries, right? Every industry, customers are really looking at how they can deliver value with AI. And so if I look at the last 3 quarters, every quarter, right, our incremental revenues on AI is just getting better, right? And when we met on the analyst day, December 17, the number we reported was 1.5 billion annualized. And now we are at 1.8. So I think the traction on AI is at a smaller base, but it's growing extremely well. And I see that continuing, because I think the more you see the value from the AI initiatives, customers are now expanding and scaling those initiatives across the portfolio. So I wouldn't want to put a number on it right now, but you'll see quarter on quarter. Now that we are reporting the numbers, you'll see the annualized revenues definitely gaining momentum.
What about pricing on some of these deals, Kriti? I mean, we've talked about this earlier as well.
Overall, new age services, the pricing is much better. And we are not seeing any pricing deflation in this quarter.
Nothing. So they're not, I mean, even compared to say 3 or 5 years ago, I mean, is there, when you enter talks for deals, pricing, etc., there's no
pricing, particularly for services like AI. Pricing is not a consideration. The customers are looking at how soon they can realize the value.
And this new age services, which is not just AI, but it includes cloud native programs, cybersecurity, that number was $11 billion in December in the analyst meet. What does it stand at now?
I think it has grown. Like we are not going to be publishing that number because we never published the service line numbers before. We made an exception because we made a commitment that we'll be world's largest AI-led service company. So we thought we'll start publishing the AI service, AI revenue. But it's growing. It's growing, but as you are asking, like the challenge is to ensure that if there is a slowdown in traditional services, how do we ensure? In fact, even traditional services need AI nowadays. So how do you use AI to spur the growth in traditional services is what we are looking at, and how do you ensure that one doesn't cannibalize the other.
The BSNL phase 2 order was expected in Q4. I mean, what is the timeline?
See, we have got the, as we told before, we got the advance PO.
We've got the PO, yeah.
We don't have the actual PO to proceed with the work. We are also waiting for the government to issue the PO.
And what would be the contribution of the acquisitions in Q4? List Engage, and that's a smaller one, but Coastal Cloud and together?
See, together, I'm just give me a minute. Like together, both. See, List Engage will be less than 10 bips.
Correct.
Okay. This would be in the range of between 40 and 50 bips on a quarterly basis.
So 50 to 60 bips in terms of inorganic contribution.
Yeah, but this is already like List Engage is already taken on a quarterly basis. So what we should expect is about 40 to 50 bips. And
will we see something large, transformational in 2026 in terms of M&A, Kriti? Or is it going to be more tuck-in, smaller acquisitions to fill those white spaces that you referred to?
We are not ruling anything out. Okay, we are looking at a broad spectrum of, but it's essentially it has to fit into a larger play. Okay, we are not going to be acquiring for the sake of just the revenue or top line. Okay, we'll be acquiring where we see there's a greater synergy, and where we are able to deliver greater value to our customers. There could be something larger if it's applicable.
By the end of 2026, you would have made in 2026 how many acquisitions? I mean,
No, I don't want. I don't want to
More
take
than
it.
three, less than six?
I don't want to take a target on acquisitions. Acquisitions is, as you see, like it will be more opportunistic. We see what is the value and do it as long as they have a larger, they fit into our larger playbook.
Would you be open to taking small minority positions in some of these areas in companies?
The adjacencies, which is
We have looked at it, taking minority positions. Again, it has to make it, again, we are not against it. We do look at certain options, but we also see, does it produce value for us? By taking the minority stake, what is the value we get? And what is the value we're able to give it to our other shareholders? If it's strengthen the partnership that we can, or if we can build, take them to a larger set of our customers and able to scale that partnership. So if that kind of synergy is there, we'll definitely look at that.
We also caught up with TCS CFO Samir Sikseria and Vice President CHRO Sudeep Kunumal to decode the quarter gone by, understand the impact of the new labour code and how it will affect the cost structure going forward and the data centre investments too. Listen in.
We'll be setting up a 1 gigawatt data center over a period of 5 to 7 years. And we'll be setting up in the capacity of about 150 to 200 megawatts and linked to specific anchor customers. The investments which we have announced is TPG is come in as a partner. We have set up a separate subsidiary for that, and 1 billion investment is from them, and 1 billion would be from us, and the rest would be debt levered. The capex would then be, made basis how the requirements of the anchor customer would be in terms of capacity, but typically that's the overall.
In terms of return profile, etc., on the business, do you have now a little more clarity? What should we expect?
As we said, we would expect an IRR of in the mid-teens to high teens.
Okay.
Sudeep, can you explain the new labour codes and what was the reason behind this 2,000 crore plus one-time expense? Is it one time? Is it for past? And going forward, does it change the overall cost structure of the company?
So, as you know, the labour code came into effect November 21st, and the draft rules have been just published, so there's still clarity emerging and so forth. But as part of our advice that we have been receiving from our advisors, what we have done is for the retrospective, predominantly, which is gratuity and leave that we carry in our books, we have made understanding of the law, and we have made a certain provision to it. And there will be significantly a small impact going forward as well, but that is not material enough. But obviously, all these things are conditional to what is the final rules that gets formalized and how it is going to be getting implemented.
So going forward, there will be a slight increase in the overall.
Very significant.
How much have you?
Very insignificant.
Very insignificant.
Very insignificant. Yes.
So that would approximately?
We're not going to quantify it because, as I said, all these things are based on the current understanding, and then what the rules actually come in, and then how we are going to be being fully compliant to the.
One more question on that legal claim. It was a CESC case, $194 million, the IP infringement. Now, you've taken a hit of 1,000 crore, approximately. Is there going to be more, or is there a possibility that even this 1,000 crore gets reversed?
So, this is on account of an adverse judgment which we received, and we had called it out through a press release. We have taken an impact on the P&L of 150 million, and there is a contingent liability of 60 million. We plan to challenge that, but basis the judgment from the circuit court, we have taken this provision.
Okay, so going forward, there's a possibility there'll be an additional hit of $60 million?
It could go either ways because we are going to challenge it.
Let me just come to M&A a little bit. Very large acquisitions in the quarter, and we discussed that with Kriti and Aarti earlier. I was asking her whether 2026 will see more acquisitions, and they didn't give us specifics, but they said, well, they're always looking. So just wanted your thoughts, Samir. I mean, is there an active discussion within how much, I mean, how do you think about, so one perspective has been that, well, the Coastal Cloud acquisition is a little on the pricier side compared to what you've paid for acquisitions in the past. So just wanted your thoughts.
So overall, we called out our 5-pillar strategy in terms of our AI readiness and what vision, bold vision we have set for ourselves. And one of the pillars is in terms of new horizons, which you talked about.
Sure.
And we have clearly called out, we are stepping up our pedal on the M&A side of it. We have seen a couple of them. It's not that we did not used to look for right opportunities and right targets. We have stepped up the pace at it. And there are active considerations. There's a pipeline. There's a specific team which is...
This margins, 25.2%. Can you break it up? The benefit on account of currency, the negative impact because of wages?
So 25.2 stable margins over the previous quarter. If you look at it, we got 80 basis points benefit from productivity, pyramid optimization, and operational efficiencies, and a further 20 basis points benefit from currency. This was offset by full quarter wage impact for the wage increases which were given from 1st of September. That was 50 basis points. And further 50 basis points was impact on account of investments in partnerships and brand initiatives.
Sudeep, the overall headcount went down by 20,000 in Q2 and now an incremental 10,000 plus. In 2 quarters, that's 5% of your overall headcount. How much of that is voluntary attrition? How much of it is on account of restructuring? And going forward, what should we expect on headcount?
So on the headcount perspective, if you really look at it, we have been hiring and we still need great talent, and both from the market as well from the university. So this time we've hired close to 16,000 people in the current quarter. And so that's the hiring that we have done. And extensive investment in talent building. I'm not sure if you've seen this. Actually, Everest Peak Matrix ranked TCS as the industry leader in future skills, specifically in AI, ML, and data services. Our training, deep skill AI and ML actually increased 3 times. So we have close to 217,000 employees today who are deep skilled and all that. So all those investments and building talent continues to do. As part of the exercise that we had announced earlier by our CEO, this quarter we had approximately 1,800 people who were impacted by part of the exercise. But again, like always we said, we did it with a lot of care, respect.
All right. Well, that's the TCS top management team talking to us about the earnings and, of course, the outlook going forward. Well, we'll take a quick commercial break here. We connect with Sudarshan Sukhani on technical trades. Mitesh Thakkar will also be with us with trading ideas. Stay tuned. Coming up.
Welcome back. Yesterday, markets recovered nearly 300 points from the day's low to close up 100 points. The question is, will we see follow-on buying today? Yesterday, Sergey Gore provided the trigger, but we need to see that momentum continue on the upside. The GIFT Nifty for now is suggesting a quietly positive start. Sudarshan Sukhani is joining in, and Mitesh Thakkar as always, to set us up for today's trade technically. Gentlemen, good morning. Thank you very much for joining in. Lots of news flow tugging us in different directions. But Sudarshan, go first. Do we see, is there a buying opportunity? Do you see the momentum continue?
Yeah, good morning. Well, it just took 2 hours for the markets to turn around. And that's too short a period to say that the trend has changed. We were breaking down. We almost reached that 25,400 level yesterday. And it's good that we have seen a rally, but does not justify a buying, idea today. We are still below the 50-day moving average. That's roughly around 25,970 approximately. And that's the area, the bulls live above that level. So let the Nifty cross that level, let it settle down there, and then we'll have many opportunities. So today I would say we'll just wait and find out what the market wants to do. I would not take any trade.
Wait and watch. Too soon to say if the trend is reversed. Mitesh?
Good morning, Nima. I have a very similar kind of outlook. While there are no signs of trend reversal, I think what we can possibly look at is a bounce back from support levels close to about 25,400, and the upside level also matches with Sudarshan. I think 25,950, 26,000 zone, which has the 50-day average, also the 21-day exponential average. So I think around those levels is where, if this bounce back can get past those levels, close above that, then I think we'll look at a proper reversal on the upside. Otherwise, it will remain a bounce back.
Stocks, Mitesh?
For the day, I have 3 buys and 1 sell. JSW Steel is a buy with a stop at 11.59 for targets of 12.25. Alchem Labs is a buy with a stop below 5,800. Here I would look for a target of around 6,000. A buy on Apollo Hospital with a stop at 72.29 for a target of 73.50. And Paytm is on the negative side, but not at the current price, about 10-15 rupees higher from here. So try to sell around 12.80. Keep a stop at 13.05. Look for targets of 12.30.
All right, let's get into Sudarshan's picks as well.
Well, it's a mix. Vedant is a buy with a VDL. It's a buy with a stop under 615. Ashok Leyland is a buy with a stop under 185. M&M is an intraday short, stop above 37.50. And Fortis is another short with a stop above 910. Generally, in this market, I have a view which is not with these not directly connected with the stocks we talk, but metals as a theme seems to be upbeat, and traders or investors may consider buying metal ETFs. I own some of them.
Okay, all right. No, absolutely done phenomenally well. Thanks very much, Sudarshan and Mitesh, for joining us with those. We take a quick commercial break here. We're going to come back in just a bit. But just a quick reminder, later today evening, we're going to be discussing hardcore markets. There's, of course, also the budget, which is 15 days away. So the road ahead for markets in the economy is the CNBC-TV18 Market Forum. And you've got some of the best minds joining us. So Manish Chokhani, Ramdev Agarwal will be talking about markets top-down. Then Ramdev Agarwal and AU Small Finance Bank management sit down and talk about, of course, the financial services journey and how to sort of identify winners there. We've got a market panel with Sandeep Tandon, Tahir Badshah, Nilesh Surana joining in terms of how to create alpha this year. A budget, what should it and what will it hold? Neelkant Mishra, Sajid Shenoy, Gautam Chachoria join in. That's the lineup that you will see later today evening, starting 4:30 p.m. Welcome back. There's 14 minutes to go for the pre-open session, which means we are 1 minute into the 40 minutes to the market open, and we're 1 minute into the pre-open session. The Nifty up on your screen, it'll settle down. We've, it'd be great if we get a 150-point uptick, but I reckon not. We'll see. 90.25 is the rupee open. 90.15 was the close yesterday. Well, the newly appointed U.S. ambassador to India, Sergio Gore, said yesterday that the next call on the trade deal will take place today, but there is no confirmation from the Indian side. Let's go across to Parikshit, who gets us this story. Parikshit.
U.S. ambassador designate to India, Sergio Gore, has said that United States is determined to get a trade deal done with India, and the next round of talks is going to take place on Tuesday this week. We've been told by sources that no formal talks are scheduled between Indian and U.S. officials on trade for that matter. Whether the United States reaches out to the Indian government now or Sergio Gore seeks to meet officials in the Commerce Ministry or the Ministry of External Affairs, that remains to be seen. And if that request were to come, the Indian officials would be more than happy to meet him or speak to officials in the US government. But for the moment, there is no formal talks scheduled between India and the United States. From our side, in December, Indian officials had said that we've already proposed a trade deal to the US. The negotiations are over from our side, and Donald Trump has to sign on the dotted line. We continue to wait for that. Indian and US officials continue to remain in touch at multiple levels. There is an air of optimism with Sergio Gore now arriving in New Delhi, somebody who's a part of Trump's inner circle. And there is a hope that with him being in New Delhi, the Indian government will have more access to someone from the US administration, someone close to Donald Trump, and perhaps we would have a trade deal sometime this year.
Parikshit, thank you very much for that. And of course, that's top of mind, front and center as far as market mind space is concerned. Well, valuations in IPOs are becoming more sensible. We've spent some time consolidating the past returns, but we are not out of the woods yet. That is the word coming in from one of the top fund managers of the country, Chirag Shetalwad, who's head of equities at HDFC AMC. I spoke with him. I had the chance to speak with him at the 16th India Investment Conference organized by the CFA Society India. He added that consolidation will continue for some more time. Listen in to some of those comments.
We're so focused on the fact that we've had a terrible 2025, and sentiment follows the market. Rising market, great sentiment; falling market, terrible sentiment. But last 5-year returns are still in their 20s. Last 10-year returns, for the mid-cap index as an example, is 16-17%. Small caps is 14-15%. So we've had a fantastic run for many years. And we've had a 1 year or a 1.5 year consolidation. And in that period of time, we are all scampering and already quite nervous. So I think we have to realize that markets have delivered a fantastic long-term performance, and that's what we're here for. Nifty is at a 10% premium, mid-cap is at a 15-20% premium, small cap is at a 20-25% premium. So you need 15-20% corrections to get you to average. Forget about below average. And the overall environment is, I would say, fairly turbulent, right? Not only geopolitics, which is extremely murky, but even the global growth environment, right? US is growing at 2.5% this year, likely to slow down next year. So I think there is still a lot of question marks. I think it's going to be a toughish year, right? Now, whether we give plus 5, 7, 8, 10% or a little bit minus, but I think as cliche of consolidation will continue for some time until valuations normalize a little bit more. I think the good news is what? The last 3 panels I've been on, everybody is nervous, right? Retail sentiment has changed dramatically. IPOs have also now slowing down, and the valuations of those are also becoming more sensible. So let us put it this way. A year and a half back, we were extremely nervous. And we were saying this is a market you should stay far away from. We've gone from being extremely nervous to a little bit nervous. Are we excited? No. But the good news is, a year and a half ago, if there was a correction, there's nothing to do about it. Now when you correct, at least you'll correct to reasonable valuations. And if you continue to correct, you'll correct to cheap valuations. So I think we're in a better environment, but we're not out of the woods yet. I mean, clearly things that happen outside of India will have a dramatic impact on us, right? I think we think that we are an India-only economy and it's the India growth story and so on and so forth. But risk appetite is global, money is global. The US is, if I'm not mistaken, 60% of global market cap. As Prashant mentioned, China is 40% of emerging market allocation. So what happens outside of India is incredibly important. And if those markets sneeze and if that economy sneezes, we will certainly get the flu as well. So we are not going to be isolated. So correlation in the long term can be low or lower, but in the short term, correlation is high. And what happens outside of India will be incredibly important. And it is certainly things to be nervous about, right? When you go into Venezuela one day and maybe Greenland the other day, and you've got another 3 years, and there's going to be a lot of news flow in those 3 years. And in the last 3 years, or towards the end of any president's term, things tend to get a lot more volatile. So imagine Trump in a corner, right? When he's not in a corner, he's swinging as hard as he can. Imagine when he's in that corner, how hard he's going to swing. So it's going to be a lot of news flow, it's going to be a lot of volatility, and most people see that as a bad thing. We see that as a fantastic thing. We want markets to be volatile. We want markets to correct every once in a while. We want to create wealth, and the only way to create wealth in a significant fashion is to have volatile markets. You want another crisis. We'd love to have another crisis, right? Because those who invested in COVID, those who invested in the financial crisis, everything, all that money did extremely well. But I think the other thing to keep in mind is this too will pass. When we were going through COVID, we thought the world was coming to an end. Genuinely. It was actually unprecedented. When we had the financial crisis, we could not look beyond it. When we had the European crisis, we could not look beyond it. We've forgotten all of those. COVID was only 2 years ago. We will forget this. And there'll be a new set of issues. And hopefully, these set of issues will create an opportunity and we'll take advantage of it. So I think the key is you got to be long-term and you got to have that character and that patience to invest. And if you do, you'll do fine.
That point about, you said you'd love a correction or a crisis, etc. You think we will get one in the next 2 years? Some serious people think we will in a large correction.
Will it happen in the next 2-3 years?
And I'm not talking about India. I'm talking about globally, like an event.
I wouldn't be sitting here if I knew that answer, right? I wouldn't be working for HDFC and be a multi-billionaire and trillionaire if I knew an answer to that question. But let's put it this way. Crisis today are no longer once in several decades, right? We live in more interconnected times. We live in more volatile times. So in my career of 25 years, we've at least had 3 or 4 massive crises. I think that is really unusual, and that will persist going forward. In the earlier generation, you saw one every 20 years. Now you see it once every 10 years. But is that bad news? No, that's fantastic news, right? You want crisis to events to take place so that we can hopefully take advantage of it.
Okay, that is Chirag Sedilwa, the voice you rarely hear from. He runs money at HDFC AMC. Well, on India-US trade deal, right? I mean, sentiment is really low. And Prashant Khemka of White Oak Capital weighed in saying that he'd be happy if he get a deal this calendar year. Listen in.
I was hopeful till a couple of months ago, based on all the comments and these things. You know, you like everyone else, you read the tweets from leaders of both countries. It seemed like by March and it should come. But then the most recent comments you hear, you know, if it comes during Trump's tenure, that will be good.
Oh dear.
Yeah.
Oh dear. That is... You're serious, not...
Well, I think it just most recently, but you never know. Maybe these are both negotiating tactics when you are coming closer to the signing of the deal. At this point in time, from whatever little I know, I'd be happy if it is in this calendar year. It seems less and less likely.
Less and less likely, let's hope. And I think Prashad himself would be hoping that it's sooner rather than later, and we don't have to wait till the next year in that sense. Well, consumer discretionary and IT are Vikas Khemani's pick. So he weighed in terms of where he's focused on in what Chirag described as a toughish year. He's bullish on NBFCs and PSU banks as well. Take a listen.
You have to look at areas where there could be good earnings growth. So I do believe that BFS as a segment, still we have good
BFSI.
legs. Yeah, as a segment, and especially within that, I guess NBFCs and PSU banks have a good legs to go from this year perspective. I think second, we can see consumer-related play, especially consumer discretionary, can play out really well in this year. Third, which could be surprising, in my opinion, or dark horse would be IT, where I guess you had good order book accretion and execution was getting delayed. That can play out, and with the currency support, I think this year you could see a better earning growth than in the past.
Okay, all right. Well, let's get the 9-10 calls then. Sudarshan joins us to help us out with that. Sudarshan, what's your 9-10 call?
It's Vedant. Buy Vedant with a stop under 615.
Got it. All right. Vedanta is the one that Sudarshan is banking on. Mitesh, what about you?
I would like to go with Alkem for targets of around 6,000.
All right, got that. Let's get to the brokerage call of the day. The other Sudarshan, our in-house Sudarshan, now joins in.
So HSBC has upgraded JSW Infra to hold and target price is increased to 280 rupees per share. It says company is on track to double its EBITDA by FY28 from the level of FY25 and will meet FY30 400 million tons per annum port capacity target with execution offering the comfort. It has trimmed FY26-27 profit estimates but has increased the estimates for FY28. Macquarie maintains outperform call on L&T with a target price of 4,620 per share. It says strong overall prospects pipeline is up 29% year-on-year, and that is led by infra and hydrocarbon orders that company has been receiving. And it expects H2 FY26 to see pickup in the execution, including some extremely large orders that company might bag. CLSA maintains outperform call on HDFC Bank with a target price of 1,200 rupees per share. It says since Q3 operational updates, stock prices corrected 6 to 7%, and feedback from investors remains pretty consistent, and deposit growth has moderated with loan deposit ratio has increased to 99%. But CLSA believes that most issues are either misconceived or temporary, and it is time for investors to overlook the noise and buy this great franchise.
Thank you very much for that. Keep your eye on HCL Tech. Could open up in the green on the back of a strong beat in Q3, where the company's top line went up by 0.8% ahead of expectations. Adjusted margins, adjusted for the impact on account of the new labour code. TCS took it below the profit line as an exceptional. HCL Tech has taken it in the employee expenses, but they've given an adjusted margin figure, and at 18.6%, it's ahead of market expectations. But what the street likes is the fact that the services business guidance has also been tweaked on the way up. So earlier, the guidance was 4 to 5%. Now it stands at 4.75 to 5.25%, which means it's not just a narrowing of the guidance at the upper end. The services business, the mainstay of the business, has seen an increase in the guidance. And even on the margin front, for this year, they're maintaining the margin guidance at 17 to 18%. But this includes the restructuring costs. The company has been optimizing its facilities. They've been even on the employee front. So there was a one-time impact that the company has been taking every quarter because of restructuring. But if you strip that out, their margins would be closer to 18%. And I think the street expects that margins next year would be closer to 18-19%. That's the margin band they used to operate at. And then they had lowered it last year on account of the uncertainty, etc. So I think the street is hopeful that margin guidance too could be upgraded next year. So all in all, it's a good set of numbers. TCS is largely in line, but the street will watch Infosys, which comes out on Wednesday, post-market hours. So we react only on Friday. Infosys, I think in pre-open, is also moving up.
Okay. All right. Got that, Rima. Well, keep an eye out on some of those companies. Top of mind would be the rice companies. As we had the management of KRBL said, relatively small, but for the industry on the whole, the number was quite large at close to around $850 million. For the time being, KRBL down, I think, only around 1%. The Nifty, though, I will interesting to see whether it can hold on to these gains 100 points higher in pre-open. Prashant?
Absolutely. And I think just a minute to go as far as market open is concerned. 100 points higher on the Nifty, building on yesterday's gains. The sensex is up about 200 points. 84,080 is where the sensex is at. First rates on the Nifty, the sensex will come up in just a bit, and then we'll look at the individual names and how stocks are reacting. What do we have? 880 or so on the Nifty, and 84,200 on the Sensex. So those are opening rates. The Sensex is up 0.4%. The small cap index is up 0.4% as well. So you got 2:1 in terms of advances to decline ratio coming up on our screens right now. 66 now on the Nifty and about 288 on the Sensex. It's a much better start as compared to yesterday. Yesterday, of course, was a goner till, of course, those comments from Sergio Gore came and the market took a U-turn. Well, the Nifty heat map should come up, give you a quick sense of where we are starting before we go any further. First rates, Eternal, Infosys, HCL on one end. On the other side, you've got Dr. Reddy's, HDFC Life and L&T, which are coming up as some losses. Rima.
Well, HDFC Bank is moving with some strength. Today, there's a CLSA note on HDFC Bank. They say, since the Q3 operational update, the stock has corrected 6 to 7%. They believe that most of the issues are either misconceived or temporary. FY27 is likely to be a bounce back year for the bank. And with the recent correction, the stock is now trading at a discount of 10 to 12% price to book to ICICI Bank. They say it's time for the investors to overlook the noise and buy this great franchise. So HDFC Bank is one of the big movers. Putting the spotlight on the IT names, HCL Tech had a positive start, but gains are now more tempered, just up close to about 0.5%. TCS in also absolutely flat. So no big gains coming through, but there is buying visible in Tech Mahindra and Infosys. Both these names are up nearly 2/3 of a percentage point. ONGC is now the big mover. ONGC is nearly up 1%. Strength seen in Eicher Motors. The rally on Hindalco continues. Since the start of the year, Hindalco is up 4.5%. Avenue Supermart seeing some green to begin trade with. On the way down, softness seen in HDFC Life, Max Healthcare, Tata Steel, Interglobe Aviation, Cipla, Dr. Reddy's. These are some stocks with cuts of nearly about 0.5%.
Well, from the broader markets, plenty of stocks are doing a jig of their own. So let's get a few of them up for you on the screen. JTL, well, that's taken a bit of a break. Yesterday, the stock was up close to 20%. They had won a large order, but the stock was up 20% today. It's seen some kind of pressure, some kind of recovery actually from the lows of the day. So JTL is the stock we keep an eye out on. Embassy Development, that stock is up close to 2%. Volume's quite large on that one. Billion Brains Garage Ventures, that's Grow. That stock, in fact, is up close to around 1%, but volumes are fairly large on that particular name. MRPL, as well as CPCL, both of them saw a big bounce up, but both of them have corrected a fair bit. Now, Q3 numbers could still be pretty strong, so interesting to see what the stocks do from here on. For the time being, MRPL is up close to around 3%, and I think Chennai Petro as well did see a bit of a bounce even in yesterday's trading session. So these stocks, remember, they've corrected close to 20% from the recent peak. GPTL Hathway, well, that stock is bursting away. That reacts to its numbers. It explains why that stock, in fact, is up and about in today's trading session. And another stock, Balu Forge, don't talk about this name very often, but this one, in fact, a few sessions ago, I think it was down close to around 18-20%. That's bounced back, and even in today's trading session, it's up close to around 5% as we speak. Frontline names that are moving up, GMDC has returned back to its winning base. Very volatile stock, had corrected close to 15% from the top. Now it's back to its winning base, up close to around 3%. And Ola as well is making it to the winners list. Well, that stock is up close to around 2%. Net, a positive start. Breadth of the market is heartening. Close to around 6 stocks advancing for one stock that's declining. Prashant.
KPI Green is coming up with some gains, 4% higher. Had a very, very volatile move after the deal was announced. Basically, had a big up move, then a big down move to below from where the price deal was announced, and now it's coming back a little bit. 460 on this one. Angel One is up about 2.33%. There is MRPL, which is coming up with about a 2.5% gain right now. The GVT&D is up 2%. I mean, sold off hard yesterday, and that is coming up with some gains. PVR Inox is up about 2.5%, and so it goes. So, I mean, these are first rates coming up. Very few names are down, and, even lesser with any volume, significant volumes at all, so nothing very much. L&T is down 1.33%, and it's got some volumes on it. I think there's some information which I think we'll put out with Vivek in just a bit from now. So that's what's coming through. Manish Gunwani is with us, Head of Equity, Bandhan AMC. Manish, good morning. Great to have you with us here. Thank you very much for joining us. 60 points and a little bit of a rebound and some breathing space, I guess, right, after those comments and the U-turn yesterday. It's been pretty bad to start to 2026, Manish. How are you thinking about markets?
Yeah, Prashant, I think we are in a bit of a very peculiar macro situation right now. The thing is, Indians are buying stocks and gold, which are, in a sense, both imported, which is putting a lot of pressure on balance of payments, which is in turn putting pressure on currency. And that pressure on currency is discouraging foreigners to come partially into the stock market. So I think this loop needs to break. It could break by dollar weakening globally. It could weak by a bit of rupee depreciation. But yes, tactically, it does look like we are caught in this loop at this point of time. It's peculiar because actually gold going up improves the balance sheet of India. I mean, we are the biggest owners of gold and silver. So structurally, it should be very positive for India that gold prices go up. But at this point, definitely there is some pressure on the currency, I think, which is discouraging foreigners from buying Indian equities.
Manish, other than the currency issue, which is plaguing foreigner interest in India, is it just the sentiment towards India that is hit? Or do you think fundamentally also, other than the currency issue, there are factors which are keeping investors at bay and keeping our returns in check?
No, there are. One is, of course, we don't have any big AI play. And China, Korea, Taiwan, which are the big weights in emerging market index, they have very big companies in AI. Second is this US-India agreement thing, which increases risk premium for India. It's not a very big impact on the economy, but it definitely increases the risk premium, especially in the perception of foreigners. So yes, there are obviously factors beyond the currency. Earnings growth is steady, but nothing exceptional. The point is, last 5 years, Nifty 50 earnings have outperformed nominal GDP. So you can't take a 2-3 year view that earnings will be anything spectacular. So there are a lot of things, but the good part is, as I said, that the macro stability at current account level, the inflation level, the household balance sheet, especially with this rise in government, there are positives as well. So we just need to, I think, wait out the storm of this balance of payments being negative. This is actually also transmitting to monetary policy that while we cut rates, the volumes, etc., are not really coming back.
All right. Hi, Manish. Good morning and good to see you in. Manish, I recall last year, you were talking about maybe the small cap index is a good place to be into.
Yeah.
And maybe, in fact, the hope is that the small and the mid caps do better in 2026 because that's what makes portfolios feel good. So when you're allocating fresh money, do you think that, these broader markets are actually providing an opportunity, or do you believe they still have more pain from here on?
Yeah, I mean, we definitely think small cap space is very interesting. And obviously, as prices have corrected both in time and price, let's say versus 1 year back, we're more positive on small cap today. We continue to believe that on a 3-5 year basis, that is the asset class which will outperform because, as I said, for large cap, the issue is if earnings have already outperformed nominal GDP for last 5 years, then the best hope is they will mimic nominal GDP of, let's say, 10-11% over the next 3-5 years. Whereas in small cap, because it's such a wide universe, there's a lot of technology change, there's a lot of geopolitical change, there are different themes you can play. So we do believe that a lot of small caps are incrementally getting into very attractive zone. But as I said, tactically, you need to see a bit of currency stability. We all know that when liquidity gets tight, small caps will not work. And we are in that situation at this point of time where if your balance of payments is negative, obviously liquidity will not be great. So we just need to time our exposure. But beyond a point, you can't predict macro. So we keep buying gradually. We are reducing cash levels in our fund, which were relatively high, let's say 3 or 6 months back. So incrementally, definitely, I think exposure to small cap should go up.
Okay, and what's the current cash levels, Manish? Since you said that you have reduced it relatively, what was it 6 months ago? And currently, what are the cash levels?
So this is fact sheet data of the small cap fund. We used to have 14-15% cash level. It is reasonably below that right now.
You're saying, Manish, that you would allocate more towards mid and small caps now? Yes. That's what you're saying, Manish, incrementally?
Yes.
Okay. Many of your colleagues across the industry are doing the opposite, Manish. They're increasing exposure to large caps. I mean, is that... Yeah, sorry, go on.
Look, it's not so much a tactical call. As I said, there are macro challenges for India. But the point is, if I take the universe that is available in small cap, I think the large and mid cap spaces are very restricted. And as I said, their earnings growth tends to mimic nominal GDP growth, which will not be anything great.
No, let me clarify, Manish. Bulk of what I have described, right? And the caveat is, I mean, what you do also what depends on what you've already done in that sense, right? So if somebody has a lot of exposure, then you trim and then go large cap. But the motivation from what I kind of picked up is not so much about capital appreciation, it's capital preservation. Protect NAVs, I mean, that kind of thing. By going into large, I mean, that's the underlying thread I could pick up. Go on, sorry.
I think clearly over the last 15 months, we have seen, as I said, time, price correction. Rupee has depreciated. So in dollar terms, we are probably for last 15 months the worst performing market globally. And I agree, next 3 to 6 months, maybe we might get a bit more correction. But I think, and we keep saying that the small cap space, you need to see on a 3 to 5 year basis. And bottom up, I think incrementally you are seeing stocks which can potentially double in the next 3 to 5 years in the small cap space. And that's usually a good return to have. So yeah, timing based on macro is one thing, but macro can change very fast. For example, if the Fed governor comes and cuts 50 bps, then all these liquidity issues will get sorted. So we can't really time macro beyond a point.
Yeah, no, we can't, absolutely, Manish. Would you want to identify, I mean, just for talk about maybe a situation, a stock where you think, it's becoming obviously very, very attractive. Just, I mean, and like at a throwaway valuation? Just as an example, Manish.
Yeah, so a lot of the global cyclicals, because they've not been the focus of the market, whether it's metals or shipping. I think the global economy is doing very well. Everyone thought US will go into a recession. That's not happening. China has kind of gone through a massive property deflation coming out of that. And I think the global cyclicals like commodities and shipping, they are cheap versus what assumptions that are being factored into earning estimates. So I think that, for example, is a space that looks where your heads you win, tails you don't lose kind of situation. I think very cheap lenders, price to book 1 or below, that continues to remain an attractive space as well. Because in India, as I said, household balances is still okay, growth is still okay. So we don't expect any big asset quality issues in lending. I think small tech platforms also are interesting. So there are a host of things that look interesting.
All right, Manish, one sector that you all were bullish on, which you briefly mentioned, was the metal space. And I think the second half of last year were quite bullish. Last quarter as well, you reiterated that stance. From here on, how do you approach it? And how would you play it? Metals have seen a melt up. Gold as well is doing well. You also mentioned about financiers. Would you go the gold financiers route? Do you think the industrial metals have more to go from here on? And within that, what would it be? Ferrous and non-ferrous. Give us some color with regard to that metals play.
Okay, the drivers are different, but I think all are interesting spaces. I think gold finances are a bit expensive right now because I think all lenders can do gold finance if it's attractive, so beyond a point. But I think precious metals obviously a trade on global liquidity. And I continue to believe that the debasement of paper currencies will keep happening. I think industrial metals also look interesting. I think non-ferrous is different from ferrous. I think non-ferrous is more about China and Europe doing fiscal stimulus, US coming back, US continues to remain resilient. With protectionism, every country is doing capex, whether it's defense or semiconductors. The demand seems okay. Industrial metal stocks have run up, but maybe there's still some space to go. I think the ferrous space is a bit dependent on this anti-revolution thing with China and also the Chinese currency, right? I mean, I think some part of your portfolio has to be positioned for extended dollar decline versus yuan, because both the hard numbers of current account and all, and the narrative about China now seeming to come out of this trade war pretty strongly. You could see yuan at 7, from 7 going to 6 or 5 over a period of time. Some part of a portfolio, which is probably steel, is the best on that. So I think the ferrous is a bit more dependent on what China wants to do in terms of capacity rationalization or how they want to handle the currency. The non-ferrous part is, I think, a bit more clear.
Absolutely. Interesting views there, Manish. It's always good to get that perspective and interesting conversation. We'll follow up on some of this in our next one. Thank you very much for joining us this morning here on CNBC-TV18. Okay, well, L&T is what we want to talk about, and there are news reports in global media suggesting that there could be some orders at risk from the Middle East. Vivek has got more details. Vivek, take it away.
Well, that's right. So L&T is in focus, like we've been highlighting. What's actually transpired is that MEED, which is a Middle Eastern news publication, that has reported over the last couple of days that large orders, this is in the country of Kuwait, and Kuwait has started discussing cancellation of oil project tenders worth over $8.7 billion. As per analysts and as per some of the data that we called out from both news reports as well as some of the order inflow announcements that the company has put out, we understand that from Kuwait itself, L&T in this particular order project pipeline, remember these are almost 6 to 7 large oil upstream projects, we understand that L&T was L1 or was favorably placed to win orders worth over $4.5 billion. So now this comes as a bit of a negative surprise, given the fact that the reason cited in the article for the likely cancellation of these orders is the fact that the order bids came in above what the Kuwait government or the Kuwait authority was actually anticipating. So this leads to a risk that there could be a sizing down, number one, of the order inflow, and number two, there could also be a cancellation of the order themselves. Now, early morning today, we've reached out to L&T as well. We are still waiting for a comment, but at this point of time, it's a slight negative development, and especially given the fact that L&T has been banking on the Middle East for further order inflows.
Thank you very much for that. On the flip side, Eternal is a big mover. Stock has surged close to about 3.5% now as we speak. So keep your eye on that. Very large volume, lots of buying seen there. And HCL Tech and TCS opened up mildly higher, turned flat, and now decisively lower. HCL Tech 1.5% gone. TCS TCS also down nearly about 0.6%. Remember, these are stocks which, like HCL Tech, for instance, went up 12-13% in the last 3 months. So tactically, people maybe have turned bullish after the recent underperformance. So some of those gains may be getting paired off. But let's talk about the new labor codes, because in TCS and HCL Tech's numbers, both the companies had to take a one-time impact, and quite sharp. In the case of TCS, it was more than 2,000 crore on the back of the new labor code. The Institute of Chartered Accountancy had directed companies that they must account for the impact of the new labor codes from Q3, so that's starting to play out. Sonal joins in with the details. Sonal.
Well, yes, ICI had notified and asked all the companies to account for the impact of labor laws starting Q3 itself. And so this is something which is not a surprise and was expected by the markets generally as well. They issued FAQs on key accounting implications arising from labor costs. And they said that 21st November is the date from which labor laws will be applicable. Still, there's more clarity required for different states. So gratuity pay, which is a 15-day pay for every year worked, paid at the time of employee leaving the organization, and leave encashment, basically the accumulated leaves which are paid to the employees at the time of leaving, these have to be considered in the corporate pay structure. Now remember, salary structures are usually structured in a way that cash in hand is more, right? And now the new definition says that 50% of the total pay must be basic pay, and so far most of the industries must be keeping the basic pay between 35 to 40%. This is as per Jefferies, which is basically 2/3 of the companies in the industry were doing that. So for compliance with the laws, a lot of these companies have changed the salary structure, and this would mean that they will have to raise the total compensation by 3 to 5% in order to keep cash in hand at similar levels as before. And around 45% of the banking and finance companies are expecting the impact to be more than 5%. Some of the other companies would expect it to be between 3 to 5%. But considering all the mitigation factors as well, Jefferies is of the view that total pay hike due to labor costs will be around 2%, and that is not as big as the street was fearing in general. According to them, the key stocks which could be impacted will be the ones which have higher India employee cost to the profit before tax ratio. There could be some recurring impact for some companies, and some of them would take a one-time hit on their P&L. These companies would include the capital goods company, BHEL, Afcons, L&T, retail, which have higher employees at the store as well, Jubilant, Nykaa, Eternal, IT companies, of course, you spoke about it earlier, pharma companies as well, and banks themselves have a higher proportion of employees which are paid. So these are some of the sectors and companies which could be impacted.
Thank you very much for that. We have with us Bala Subramaniam, a Senior Vice President, Team Lead Services, now joining in. Mr. Subramaniam, you want to, in a way, quantify the impact. And is this a big hit for the companies? This retrospectively, it's one time, but going ahead, is their annual recurring employee cost bill going to go up?
Hi, morning. Thank you so much for having me. As we speak, we are in the process of implementing the labor codes for all of our customers as well, and we have over 3,000 customers on a base of 3.5 lakh contract staff. And yes, the impact of the labor codes are such that there is unification and simplification of various non-CTC components, such as if you look at PF, ESI, statutory bonus, your gratuity, leave encashment, and all of these things have a unified and singular definition of what wages are. Because unfortunately, until before the labor codes, wages, the interpretation of wages was subjective. And now it's become just unified to one number, which is your total remuneration, which is your CTC. And because of the simplification, what ends up happening is that especially at the entry level, the cost of compliance, that is the PF components, and even the ESI bracket, that is the coverage of people under ESI, has gone up significantly. I'll just give you an example. If you look at how things were before the labor codes were implemented, up to 21,000 rupees of gross wages was the maximum limit under which a person would be covered under ESI. If you look at the entry-level hiring in most formal jobs today, the salary should be just about 21,000, but below 42,000. But now they have made it 50% of total wages, which means whoever is even at 42,000 rupees of salary would still come under the ESI bracket. So ESI contribution is now an additional cost that companies have to bear in order to maintain the cash in hand or the net take home constant. So that's an additional cost. And apart from that, because the wages definition has been standardized now, the provident fund contribution has also gone up. But then when we did this calculation for, let me take the example of one large company for whom we implemented it very recently, on a base of 10,000 people, for about 4,000 people or so, the net take home actually went up. And for another 4,000 people, it actually went down, marginally though, right? Very, very marginally, but the overall CTC actually remained constant or slightly went up. So the cost may go up marginally, but then this is something that can be consumed within one increment cycle itself. So it's about making sure that this is absorbed within one increment cycle. Typically, companies pay out anywhere between 7 to 12% as annual increments, and it can be consumed well within that, and then we move on. So it gets regularized in just 1 year.
All right, let's get in Mr. Raghuvanshi as well into the conversation. Mr. Raghuvanshi, what do you make of these changes and the potential impact on companies?
Yeah, good morning, everyone. I think, the issue is that at one end, we are trying to, work on the ease of doing business, and codifying this new labor law is a positive step in that direction because it helps in several ways, especially with women in the workforce, enabling women in the workforce, and in several other ways, also creating a social security net for people in the gray collar or the blue collar job market. I think the issue is the cost of doing business as a result of this new labor law, which is going to go up significantly. And we have to remember in India, it's less than 7% of our people are in employment in the private sector. And these are jobs. So we are just basically increasing the cost of, employing people. And, that's going to have an impact on corporate margins. But I think it's going to be a little more nuanced. The Gratuity Act, the Payment of Gratuity Act 1972 limits the total amount to 20 lakhs. That doesn't mean that companies cannot pay more than that. But because of the income tax limit and the limit under the Payment of Gratuity Act, a lot of companies limit it to 20 lakhs. So I think you'll have to go company by company, analyze their annual reports to see what their gratuity computation rules are.
Mr. Subramaniam, Bala, I've just come in on the increased cost of doing business now. Particularly, the fear was the hit to quick commerce companies because they employ a lot more gig workers who will now come under the Social Security ambit. Now, Team Lease has also been providing, for your gig workers, quick commerce has been a big source of growth engine. It's been a big source. So can you give us some indication of the increased cost structure for them?
Not really sure if the overall cost of ownership, the total cost of ownership will actually go up even for gig workers. And the reason for this is because most, if not all of the platforms who employ gig workers or the logistics companies for that matter have been providing some form of insurance / coverage for them or the other. Now, what are really the demands that they have? You look at it in a fourfold manner. They look for health cover, accident cover, life cover, and retirement benefits. It's not like they have not been provided these things so far. It is just that companies at their own discretion have been providing them at a significant cost because they have been providing them through third-party insurers. If the government can step in, as they have announced as part of the Code on Social Security, and ensure some sort of cover and social security benefits for these people, then it's just a substitution of cost. Instead of paying insurers, you pay the government. and the government will be able to provide benefits hopefully disproportionately compared to what insurers can. If you look at ESI, for example, the government has not really announced if the contribution from gig workers or towards gig workers will be made specifically towards PF or ESI. But I'll just give you the example of ESI. It gives unlimited cashless health cover for self and up to 7 people in the family. How many people even know this? And that's something that only the government can provide. No insurance company will be able to provide that. So it's just a cost substitution, like I said earlier, where instead of paying private parties, you're going to pay the government, and the benefit should probably be the same or hopefully will go up.
Okay, gentlemen, we'll leave the conversation here. Thank you very much for joining in. For today, we are seeing HCL Tech and TCS perhaps reel under the impact of the new labor code, which has impacted the company's bottom line. For HCL Tech, for TCS, it's more than 2,100 crore. For HCL Tech is a number in excess of 700 crore rupees, which is why both the companies missed estimates on the bottom line. Operationally, it was a good set of numbers, but all in all, these are companies which are not growing very fast. As Nomura pointed out, for TCS, the dollar revenue growth estimate, Nomura on TCS, is minus 0.7% this year, and that will go up maybe marginally next year, 2.5%, 3%. So these are still slow-growing companies. Even for HCL Tech, on the whole, the revenue growth this year will be 4 to 5%. So which is why maybe investors are still on the sidelines, and these companies' stocks actually did well in the October to December period, where there was a bit of a catch-up rally. So we had a conversation with HCL Tech CEO and MD, C. Vijay Kumar, CVK, and CFO Shiv Walia, and we began by asking CVK more about FY27. What are the leading indicators suggesting? Will the momentum continue? Can FY27 be better than FY26? Listen in.
We've delivered a very, very strong quarter on all dimensions. And this is the second consecutive quarter of strong performance. So I think FY27, as you know, there is so many moving parts in the world. There's a lot of volatility. But what I can reasonably share is some of the leading indicators that we have. We have done very well in the last 2 quarters. And given the strong bookings in the Q2 and Q3, the Q2, Q3 booking is almost 30% higher than in the same period last year. So we are looking at some good uptick in revenue in Q4 in the services, and then, of course, Q1 as well. So I think given our booking, given our pipeline, and all the momentum that we have, we are looking at a good outcome in the next year. However, anything specific, we will really have to wait for the April meetings.
Shiv, there is this one-time impact on the back of the new labor code. But beyond that, what is the anticipated recurring income on the annual employee costs?
It's going to be minimal. We have taken the one-time true-up charge. It's going to maybe 10 to, at best, maybe 20 basis point going forward. So we don't expect impact beyond that.
Okay, so 10 to 20 basis points. And on restructuring for FY26, what will be the total restructuring cost? But could you put that in rupee crore, and the impact that you expect on margin shift? And will this restructuring cost continue into FY27? And what happens to, is there a possibility that if it doesn't, margins can get back to the 18-19% band?
So as I indicated last quarter, the overall cost of restructuring is going to be around 50 basis point this year. We have done most of it, and hopefully the next quarter is also going to be the similar charge, around 40 to 50 basis point. Our endeavor is to complete this exercise this year and move to next year with a clean slate. So I don't think that's our endeavor, but we'll update you when we close our year in April.
Okay. So the overall impact in Q4 will be 40 to 50 basis points. And for FY26 also on margins, it should be about 50 basis points, correct?
No, the full year is 50 basis point. Yeah. And next in Q4 is going to be similar to what we had this quarter. Q3 is around maybe 60 to 80 basis point.
CVK, what has been the achievement out of this restructuring exercise that you've undertaken in terms of the overall employee headcount, in terms of utilization of your workspaces? Can you give us at the end of it, what have you achieved?
So I think in Q1, we saw a little bit of mismatch between skills and location where the people were available. And we also had some underperformance in some of our acquisitions, especially in the automotive segment in some of the Western geographies. So we have optimized some of this in the last couple of quarters. And that's what you see the restructuring costs are. Facilities as well across the world, there are many facilities which are not being fully utilized, so we have done some rationalization. All of this is has been the part of the plan since the beginning of Q2.
But have you had to let go of people on the back of this restructuring? If yes, what's the number?
Yes, we have had some very small numbers. We haven't called out any specific number, but largely it's outside India in some of our geographies. We've had some exits for sure.
This year, the guidance does not include the acquisitions that you've done, Jaspersoft, HPE. But next year, what will be the contribution of the acquisition?
It should contribute at least 1.5% in FY27, assuming things close by end of this year, which is by March or early April. Roughly 1.5% growth to the overall company is what we expect.
Will you continue to make acquisitions, bigger, bolder ones in size perhaps?
We're not really looking at scale acquisitions. It's really capability-led or some geographies where we really want to accelerate our presence. That's where we will be looking at acquisitions. We don't think we're going to do a very large-scale acquisition. I don't think that's in our plan.
And getting back to margins of 18 to 19%, does that happen in FY27?
Even this year, Rima, we are, if you take out the restructuring cost, we're only some 10, 11 basis points off this quarter after taking out the restructuring cost. So we feel pretty confident of getting to our 18 to 19% range in the next year.
Oh, that's good to hear. And a little more on AI. Now, it's been 2 quarters since you've been sharing the advanced AI revenues. It's about 4% of your overall consolidated revenue, growing very fast. What is the momentum that you're seeing on AI? And, what can that number in terms of revenue contribution go up to?
Yeah, I think there are 2 aspects to this. One is advanced AI, which is really a lot of work which is required to get AI infrastructure enabled, the silicon work that we do to build, design edge inferencing chips, some of the agentic solutions, some of the IP that we have in AI. That's really what we call as advanced AI revenue. But we have a much broader canvas where we have deployed AI in service transformation, application modernization, data lifecycle. So it's a much bigger canvas when you consider AI. And we think almost every part of our business should get significantly influenced by AI as the time progresses. But advanced AI is really a leading activities like build out of data centers, all the professional services around design and implementation of data centers, silicon, and all the IPs that we have built. All of that is what we call out. We think there is a strong momentum. It's growing now 20%. Even the previous quarter, it grew even higher because we had just called out, we exceeded 100 million, but now we are at 147, 148 million per quarter. We think there is enough fundamental reasons why this will continue to grow at this speed for a few quarters.
That is HCL Tech saying that the momentum should continue in Q4 and Q1. FY27 margins should get back to 18 to 19%, which is higher than the guided band of 17 to 18% this year. And next year, the acquisitions done by the company will benefit their top line by 150 basis points at least. And going forward, the new labor code will have a very limited impact on the company's cost structure. Margins could be impacted to the tune of 10 to 20 basis points. So that's the summary coming in from HCL Tech. Get into a break on the other side. Somil Mehta of Mirae Asset Sharekhan joins in for some technical trading ideas.
Welcome back. Somal Mehta is with us of Mirae Asset Share Khan. He's joining in with what he wants you to do as far as approaching the market goes. I mean, we're off the highs and I think the market's now in the red. Reliance, I think, is one reason. It's down 1% again. Heavyweight, which is having outsized influence as always. Somil, what's the recommendation? I mean, sentiment still is fragile, even though we saw that rebound yesterday. But in terms of taking trades, what would you recommend?
Hey, hi, good morning to everyone. Now the trend remains negative on the in the short term. Trading below Nifty, trading below 20 and 40 daily moving average. A sell-off which we saw in the last week has broken an upward sloping trend line on the daily charts. The entire, the consolidation which we saw between 26,300 and 25,700, that has broken on the downside. The structure has looking a little weak from here. Now, the resistance from here is 26,000, which is the 20 daily moving average, and I'm not expecting markets to go above that. So my view remains negative in the short term. However, in the medium term outlook, we are still on the positive side, and I'm not expecting, too much of a sell-off from here. But on the downside, my targets would be 25,300 and 25,200, which is very close to a 200 daily exponential moving average on Nifty. So sell on rise should be the strategy in the very short term. And I think railways are looking really weak from here. However, metals and banking are looking flat to positive. So I'll be staying away from them. But mid caps are looking weak, definitely.
Anything on HCL Tech, TCS? The numbers were not bad per se. TCS, you could say, were not exceptional, no big, positive surprise, but not negative either. And HCL Tech, actually, we got a guidance upgrade at the services, the main services business. So what is it technically that the charts are looking weak, that we are seeing a correction today?
No, not in the IT side, not for HCL Tech and TCS. There could be a little bit of correction in the very short term where it can go till HCL can go till 1580 levels, but not in the medium term outlook. Medium term outlook still remains positive, and I'm expecting the stock to take support at these 1550, 1580 levels, and then again start the up move. But in the very short term, yes, we have seen a sharp sell-off right now today, closing and trading below 20 daily moving average. So in the short term, yes, negative, but in the medium term outlook, it will be a buying opportunity around 1580 levels.
Yeah, got that. Your specific trades in terms of stocks, Saman?
My first trade would be on IRFC. IRFC is trading below 200 daily moving average. Have already started low top, low bottom formation. A small consolidation has also broken on the downside. So the stop loss would be 127 and the target would be 112. So that would be my first trade. The second one is Hudco. Hudco, very similar, very sharp bounce we've seen in the last couple of months. And then now again, a sharp sell-off closing below 200 daily moving average. My stop loss would be 220 and my target would be 205.
Yeah, those are individual trades. Samal, do you have a technical view on Reliance?
Reliance, very similar to Nifty actually, because it was trading in a very broad range of 1520 and 1600 levels. So that range has broken on the downside, forming low tops, low bottom, trading below the averages. Now, very crucial levels at 1430, 1450 levels for Reliance. I'm not expecting that to break on the downside, but if it breaks on the downside, because I'm being a little cautious on the markets now, if it breaks on the downside, then the next level is 1300, 1330 level. So sharp sell-offs if that crucial level breaks. So I'm hoping the medium-term levels to hold right now.
I mean, look at the market go, right? 87, 90 points lower now on the Nifty. As we were talking, and I think another 20, 25 points gone, Samal. So not being able to hold at all with what we're seeing out there. I just have to say one thing though, so far, and maybe, this will also now follow what the Nifty is doing. Market breadth is still positive. So some 1700 stocks are higher and about 1100 stocks are lower. I'm talking about the NSE advanced decline ratio. Of course, I mean, the gap is converging, and we'll see what happens. But for now, more up than down, even at this point in time. Just a few other names. MRPL is still holding with about a 3.5% gain. Ixigo is coming up with a 4% gain. I mean, you know, these are all stocks which have seen large corrections. Ixigo high was about 350. It fell to about $200. So Ixigo is coming up. Jindal Stainless is up about 3.33%. Balaji Amines, you know, fair bit of volatility recently around the 1,050 odd rupee levels. That is Balaji Amines. Rajratan Wires is up another up 5% or so. So I mean, you know, here and there some moves, but nothing very large per se. Dixon is coming up with some pressure. 2% lower on Dixon at this stage. There is what else? Glenmark, which is coming up with about a 3% cut. So that is meaningful on volumes on the downside. Senco is down about 1 3/4%, and then there is Misho, which is down about 2% as well. So, well, broadly, you would recommend those if you're trading, especially if you're on the F&O side, etc. I mean, reduce position size and, I mean, you've got to be a lot more nimble.
Absolutely, absolutely. So, what my strategy would be to, if you're long, and if you're long, then stay on the large cap side. Don't go outside banking and metals, because those are the only sectors I'm looking as a very positive side right now. Not in railways, not in pharma. Also looking a little negative from here. Fortis giving up all the gains. Glenmark Pharma giving up all the gains. So I would stay with the large caps if I'm long. But if I want to go short, mid caps are going down. They are I'm expecting very sharp sell-offs in mid caps and small caps. So yeah, shorting opportunities definitely. Put options would be a great way to trade them, having a less risk on the side. But yes, going short would be the right strategy in the short term.
Short in the short term. Samal, thank you very much for joining us. Good speaking with you, and good to get those trading ideas. And broadly, I mean, the setup as things stand right now. You know, we'll start to have a lot more budget conversations, because the budget is 15 days out, right? Now, here's Chirag Shetalwad of HDFC Mutual Fund making a very pointed argument that maybe we should loosen the fiscal deficit as a percentage of GDP number a little bit. I mean, spend a little bit more like other countries have, and maybe this is the time to do it. Just listen in.
I think the budget, as you said, has lost relevance. But I'm sure post, I see the views post every single budget. Every budget has been a 8.5 to 9 on 10. Every budget has been growth oriented. Every budget has been sort of fiscally prudent. I think we got to go beyond it, right? We have 365 days for the government to introduce reforms and measures. Why are we focused on that single day? I think the key question, though, in more seriousness is how they view fiscal prudence, because this year your tax collections have been far below target, and your expenditure still has to be cut fairly substantially in the next 4 months to meet your expenditure targets. So chances are you'll exceed your expenditure targets and you'll underplay your revenue targets. So the question is, will this government stick with its discipline on the fiscal side or not? And I think there are a lot of people, and I suspect I could be one of them, is maybe we shouldn't, right? We don't have to have this holy grail of fiscal discipline. If we're in an environment of uncertainty, maybe you loosen it up a little bit. Other economies have done that, so why can't we?
Get into a break. We'll keep hearing more from these conversations. For now, we'll slip into a break with the news that the Nifty is down about 50 odd points. Manisha Gupta will join in and put the spotlight on the commodity space. Stay tuned. Welcome back. As promised, let's talk commodities, and commodities on a high once again. Manisha is here to give us more details.
Thank you so much for that. Well, gold, silver, copper all trading near all-time highs, and platinum is up 15% in this year. But what is also running higher is the crude oil prices. If you look at the Brent and WTI numbers, we're looking at gains coming in for that one. So 64 plus, and Brent with that is trading at a 1-month highs. If you look at the WTI, that is the US crude oil prices, they are trading at a 7-week highs as well. Overall, the prices have gained up by 5% in this week alone, and this is after prices declined 18% in all over 2025. Well, 3 or 4 factors which really seem to be supporting the crude oil prices at this point in time. One clearly comes in from Iran, with US latest levy of 25% tariffs on Iran's trading partners with immediate effect has led to supply disruption concerns coming into the market, and that has led the prices higher. Remember, the US president also have warned of a possible military action against Iran. Now, Iran exports 2 million barrels per day, and it is 4th largest producer exporter when it comes to within the OPEC cartel. So important country there, and with what seems to be happening within the country and with the US statements, we are looking at that premium building up in case of crude oil prices. The second thing, of course, is about the uncertainty over Venezuela's crude shipments. While we do understand that there are US companies which are willing to now move crude oil from Venezuela and invest on a longer term as well, but the near-term uncertainty just about stays. Third point really comes in from Kazakhstan, because here as well, the oil output is affected by adverse weather, and it is not just about a week or 10 days. It has been happening for last 3 months or so, supporting prices. The Russia has been yet another strong one when it comes to crude, and even as it has been 3.5 years of war there, we've seen Russian crude more or less continue to go out. But the infrastructure damage that has been caused by Ukrainian drone attacks in the last 4 or 5 months has led to 16 to 17% of a decline therein. And then it also is about Azerbaijan, where the oil exports have declined on an year-on-year basis. Last year was 24.4. The year previous was 23.1 million barrels there. So we have seen constant declines from major OPEC producers there, supporting prices. Dollar index declining. It has been about macros as well, supportive. And then the street will also watch out for the U.S. Supreme Court ruling on the legality of U.S. tariffs. That announcement comes in on Wednesday. Having said that, when you look at the outlook for crude prices for 2026, it has been a very range-bound trend that the markets believe you could be looking at in this year. The first quarter, street believes, is going to be of surplus, but going forward, then the demand will start coming back, and that is when you will see crude prices supportive as well. So between 60s is what UBS, Bernstein and DBS believe that you could be looking at the crude oil prices, $60 to $68 a barrel of a range forming there. But then the others are not so bullish. You have $55 of an average coming in from IEA, Goldman Sachs, ABN AMRO, Capital Economics, all of them believing that mid-50s is where the crude prices could be as an average for this year.
All right, Manisha, thank you very much for that. So that's oil price forecast into 2026. We'll take a quick commercial break here. Lata speaks with Macquarie Suresh Ganpati on what to expect from the banking, NBFC and insurance companies when they start posting numbers for the third quarter. Stay tuned.